Monster Capital 2025 market predictions. As we look to put a lid on 2024, it's time to start thinking about how to approach the markets in 2025. Don't get caught up being unprepared, panicking, or choking on a big glass of FOMO, wondering why you didn't see the moves coming. Today, I'll walk you through my financial and economic outlook for 2025. We'll cover everything from a potential S&P correction, inflation, trade tariffs, Japan, dollar yen, bonds, China, Europe, gold, and Bitcoin. So let's break down the key trends, what's driving them, and how they might impact your portfolios. But before we dive in, just a quick reminder. I am not your financial advisor, okay? These are my independent thoughts from my own research, and I'm sharing them for informational and entertainment purposes only. Always do your own due diligence and put in the research time that matches the level of success that you're looking for. Trade tariffs. President-elect Trump has proposed steep tariffs, 60% on goods from China and 10 to 20% on imports for the rest of the world. These protectionist policies are expected to strengthen the US dollar by reducing trade flows and increasing domestic currency demand. While domestic industries, especially manufacturing and businesses with localized supply chains, may benefit, importers, exporters, and multinational companies relying on global supply chains could face challenges. These trade tariffs are a pretty big deal, and it has all our trading partners on the edge of their seat, and not in a good way, as these tariffs will affect almost every asset class either directly or indirectly. Essentially, all imported goods subject to these import tariffs become more expensive, opening the door for made in the USA type products, as well as higher quality alternatives from countries like Japan, where there is a cheaper yen, to gain favor from US consumers. Japan and dollar yen. Being a Japan guy, I should probably share my thoughts on Japan and what to expect. The Bank of Japan, or the BOJ, is in a rate hiking cycle. While much of the world is cutting rates, Japan's shift from negative interest rate policy, or NIRP, to zero interest rate policy, ZIRP, and potentially positive rates in the future is significant. A rate hike here could trigger another global sell-off due to the carry trade being unwound. For those unfamiliar, a carry trade is when investors borrow capital at low rates, often in yen, to invest in potentially higher yielding assets elsewhere. As these trades unwind, especially if done quickly and all at the same time, we could see a massive global sell-off, similar to what we saw this summer. So what would benefit on a rate hike from the BOJ? Well, Japanese banks would, like the mega banks like SMFG, MUFG, and Mizuho, as well as some of the smaller regional banks and other financials, which would rally due to increased net interest income that they would receive. The other things worth mentioning about Japan is it is investable. You have political issues in Korea. You got China dealing with potential US trade tariffs and putting out their own real estate fire. And Taiwan is always wondering if this is the year that China's gonna take back the country. I mean, for all but 4 of the last 69 years, the LDP has been in power in Japan, making it very stable. And as I said before, investable. You don't have to worry about political coups or a government saying you can't sell your stock, or an embargo that means you can't go and get your supply chain out of the country. Now, on a structural level, the Tokyo Stock Exchange reforms continue to prioritize shareholder returns through dividends, buybacks, and the unwinding of protective cross-share holdings. Trade wars could further amplify demand to Japan's high-quality goods, as opposed to equally or overpriced inferior goods from other countries. Additionally, Japan remains a target-rich environment for M&A, or mergers and acquisitions. This year alone, activists in Japan bought $6.5 billion in equities. So everybody's carefully watching how the Seven & I saga will play out. Now, I gotta be careful how I say this, but Alimentation Couche-Tard, ticker ATD, Canadian convenience store giant. They were trying to take them over, but all of a sudden they started approaching all these buyers for their Ito Yokado supermarket units so they can restructure, because now they want to fix their poor track record in creating value for shareholders. Funny that. That's how a corporate governance initiative is supposed to work. It's like bully ball and essentially squeezing these big companies to comply, so the smaller ones have to follow suit. Japan is a buy, and that is why. Many Japanese companies are undervalued, inefficiently managed, and just not focused on profitability, making them ripe for takeovers unless they adapt. I mean, look at Hitachi, ticker 6501. It's a prime example of a Japanese conglomerate reinventing itself by getting its corporate governance in line, shrinking its broad-based footprint to focus on global growth. I mean, they went from 1,000 consolidated subsidiaries in 2015 to 614 currently. 22 of them were listed on the Tokyo Stock Exchange, and now only one is. So this used to be a hardware stock that people didn't really want to own, and now it's a growth stock up 800% since March 2020. This is the poster child of what Japan is trying to do with all their listed underperforming behemoths. Now regarding dollar yen, the yen is currently hovering around 155, which is just too cheap. If the BOJ raises rates while the US is cutting, we could see a much stronger yen amid another shakeout of that carry trade, and really just based upon the US-Japan rate differential in and of itself. If that happens, my hero call here is that the yen starts to trade in the 130s again, around that 50% retracement level on the 10-year dollar-yen Fibonacci chart. And you can also see that same level on the 20-year chart, right around the neckline support. But my gut says it may even touch up the 120 range, high 120s. However, I doubt it appreciates through 125, as it would start to harm inbound tourism, export competitiveness, and foreign investment in Japanese manufacturing. It's basically everything Japan is working so hard to propagate. So all Japan has to say if they do raise too quick and they rock the boat is, sorry, gomen nasai, they do a couple bows, and then they say, we won't raise again for a long time, sumimasen deshita, gomen nasai, and they're good. And then the carry trade gets put back on again because rates, even if they do get raised into positive territory, will undoubtedly still be ridiculously low. Overall, my view is yen appreciation in 2025 is pretty likely. Inflation. In 2025, inflation levels are expected to remain elevated, driven by supply chain disruptions from the trade tariffs, wage growth, energy market volatility, and tighter immigration policies. While central banks worldwide are easing, except for the BOJ, there is potential for inflation to start creeping higher again. Currently, US inflation is hovering around 3%, close to the Fed's target of 2%, but still far below the COVID pandemic era of 9.1%. However, the Fed is unlikely to cut too aggressively. They'll want to preserve ammunition in case the trade war with China intensifies and this sort of self-formulated inflation starts to get carried away. This means inflation isn't going away anytime soon. Nor do I think mortgage rates for home buyers will see significant relief. And if anything, they may be chasing higher home prices, but still paying the same rates that they're paying now on these loans. Bonds. The outlook for 2025 is mixed. Shorter duration bonds may remain attractive with elevated yields, while longer duration bonds could struggle if inflation persists. However, if inflation moderates later in the year, higher quality bonds could start to recover. The yield curve at the moment is flat, but as the Fed cuts rates, a likely scenario, an expected scenario, we could see the curve start to steepen, which normally would be a good time to start gradually moving out of cash and into longer-term bonds. There is a bit of speculation, though, that if the Fed doesn't cut rates as deeply and frequently as expected, at least with respect to longer-term bonds, there may not be much of a rally to speak of. And on current positioning, I agree, but I think longer-term bonds are a decent place to park some of your money. It helps with diversification, and it's a conservative investment. Just to be clear, I'm long TLT, which is an iShare 20-year Treasury bond ETF. Small position, but still, I wanted to have exposure. Europe. So everyone's out there slagging Europe, but in my mind, Europe's not really in that bad of a situation right now. I mean, there's a little bit slower growth, there's political uncertainties in France and Germany, and you have the ongoing Russia-Ukraine conflict. Add to that potential trade tariffs from the US, and yeah, I get it. But macroeconomic conditions have been improving across Europe. I mean, GDP is better than it was last year, and the ECB is in a cutting cycle that's frankly more aggressive than the US, with inflation back around that 2% range and firmly in control. If the US trade tariffs do go through on Europe, and specifically on China as well, doesn't that mean the EU and China will do more business and potentially capitalize on all these untapped synergies that they weren't able to explore because the US has been monopolizing both sides? Anyway, that's just my thought process, and that's kind of where I see upside as well if this all goes through. The companies I'm always looking at in Europe are BMW, Benz, Novo Nordisk, ASML, LVMH, Hermes, L'Oreal, Airbus, Ferrari, and Unicredit. And I think they probably all do better than expected. Story time. Okay, so I just mentioned Ferrari and Unicredit, and it kind of made me think of this time when I was at UBS, right? So the CEO of the investment bank at UBS at the time was a guy named Andre Orchel. I had dinner with him a couple times, and one time even dropped him and his chief of staff off their hotel after dinner. So I had multiple times chances to chat with the guy, and honestly, I would put him and probably Rich Handler from Jefferies in my top 3 investment bank CEOs of all time. I mean, I don't really have a third. I was trying to think about it. If you guys have one, throw them in there in the comments. I'd be interested to hear. Anyway, back to Andrea. The guy is a smooth operator. Very nice and easy to talk to, but also unapologetically ruthless. He's kind of like the Kobe Bryant of investment banking. Like at dinner, I was thinking, man, I want to be like him when I grow up. And I'm thinking, wait, the dude's only like 15 years older than me. So shit, where did it all go wrong? So he was in Tokyo for a town hall meeting. And at the town hall, where he's given the current state of affairs of how everything's going, he said something that made pretty much every dude in the entire place like lean back and go, a little bit of a gaze over their shoulder. He was talking about UBS in an impassioned speech. And he's like, listen, do you want to be like a Fiat or do you want to be like a Ferrari? And he goes, I want to be a Ferrari. And just the way that he said Ferrari, everyone in there was like, what? To hear a smooth Italian guy say the word Ferrari, it's like hearing it dripping out of Enzo's mouth himself.
Originale della Ferrari.
After the town hall, everyone is around for drinks and we're like, damn, did you hear him say Ferrari? Like, what a stud. We all wanted to be like him. And he came over to us and, you know, we basically all just asked him if he could say Ferrari in that Italian accent one more time, which of course he did. Anyway, you know, the guy is awesome. And if you ever had doubts about Andrea Orcel and the value that he brings, like Santander, oh, low blow. Check out the chart on Unicredit from when he started in April 15, 2021 to where it is now. Yeah, it's up over 500% for Unicredit versus 83% for Santander. It's an interesting story. If you ever want to check it out, you should. Again, I'm just saying, this guy's a complete stud. Now, if you haven't done it yet and you're thus far enjoying the video, please do me a solid and take a second to hit that like and subscribe button. It really helps me in trying to grow this channel and provide tailored content to the community.
Please, sir. I want some more.
Okay, enough of the Oliver Twist. Let's continue. China. The outlook for China is less optimistic. The property sector faces structural challenges with supply outstripping demand and consumer confidence waning. Major developer defaults and unfinished projects compound the issues. While China's introduced measures like relaxed purchasing requirements, tax incentives, and mortgage rate cuts, the impact can be seen, but it's just not enough. Analysts are even drawing parallels to Japan's lost decades, where it took 35 years for the Nikkei to recover to its peak. Additionally, heightened trade tariffs would further suppress China's growth. 60% tariffs from their biggest trade partner would be crippling, not just for China, but for the rest of the world, really. So, in my opinion, I don't see it happening. I think the trade tariffs will probably be pretty steep, or China will have to give up something pretty substantial to really get those tariffs lower. But you know, for China, unless valuations become exceptionally attractive with some crazy type of stimulus attached, I'm staying cautious on Chinese equities. What exporting nations would benefit from China stepping back a bit as the US's largest trade partner? Well, India, Vietnam, and Mexico are probably the ones with the best chance of gaining market share. But you could probably throw in Thailand as well, maybe Brazil. Gold. Gold remains a strong contender for 2025, supported by inflation, rate cuts, geopolitical risks, and potential dollar weakness in the second half. Prices could hit $2,700 per ounce again pretty easily, with gold's low correlation to other assets making it a valuable hedge. Central banks may continue to add gold to their reserves if prices actually dip too much. Personally, it's at an all-time high, and I still think it bounces off that ascending channel support level it's at right now, where you can see it's trading at the bottom of the channel, and likely starts making it move higher to break through its all-time high of 2790. I do think it hit 2801 on futures, but I mean, what's stopping it besides investors being massively long already? 4 years of Trump? I mean, when you hear that, read complete uncertainty, right? So why not? I mean, gold does better in times of uncertainty, so it's definitely on my radar. Technically though, it's trading below its 50-day moving average and sitting right on the bottom of that channel. You can see it right there, just on the bottom, and just above the 100-day moving average at 2602 and change. So to say it's at a precipice is an understatement. That being said, I do think the 100-day holds and it breaks higher through the top of that ascending triangle that you can see. Bitcoin. Bitcoin is another asset to watch. Despite regulatory hurdles, Bitcoin has gained legitimacy as institutions explore its potential as an inflation hedge. Breaking that 100K resistance level solidified its standing. And while dips are inevitable, Bitcoin's long-term trajectory remains upward. And as I said in my What to Buy If Trump Wins video before Trump got elected, a significant catalyst could be the establishment of this US strategic Bitcoin reserve, which arguably is the biggest delta to Bitcoin supply and demand right now. If that happens, this puppy will be at 150K faster than Cool Papa Bell can hit the light switch and be under the covers before the room gets dark, all right? US equity market. Let's discuss the US markets. The S&P 500 faces potential headwinds from trade tariffs as well. That could hurt the overall EPS of some of the biggest S&P constituents and very likely could lead to a 10% sell-off when calculating all those EPS hits to the bottom lines. Not to mention technically, but from a Fibonacci perspective, there's a 10% drop down to that 76.4 retracement level of support around 5,500. This sell-off could be all mitigated actually if either the China tariff isn't as bad as anticipated or if Trump is able to implement his corporate tax cut programs in full. Sectors and themes I'm looking at this year in the US. Financials and energy from a deregulation standpoint. I've addressed it in previous videos, but I like both banks and energy plays. The materials sector. The materials sector benefits from a falling interest rates perspective. The risk here is that the mats have a high beta to China growth. So if the China-US trade war really kicks off, you can write the material plays with high China exposure out of your portfolio pretty quickly. Consumer staples, they benefit from the Fed cutting rates, a strong economy, and generally would be impacted less by trade tariffs. I like Procter & Gamble, ticker PG here. So I think NVIDIA and the rest of the AI pack may take a bit of a breather. I mean, it's looking that way already, while the rest of the US market plays catch up. But by no means is the AI trend over. I mean, it's literally just beginning. The future is going to be about implementing AI into even more areas of business with hopes of streamlining efficiency as well as in data centers and how to properly power them. Defensive spending is always on the forefront with the Republican regime change, and especially when the 2025 National Defense Authorization Act calls for $923.3 billion in US military spending. That's up about 4.1% from last year. I'm always looking at Lockheed Martin, ticker LMT. I'm looking at General Dynamic, ticker GD. I'm looking at Raytheon, ticker RTX, and Northrop Grumman, ticker NOC. The risk here could be that the conflicts with Russia and Ukraine and Israel and Hamas could de-escalate, which is a great thing really, but also risk lies within the new Doge Commission with Musk and Vivek that could lead to a cut of a bit of the fat out of this budget. Healthcare plays are also likely to do well in 2025. Having underperformed last year, there's a bit of catching up for them to do as well, as the potential for the new administration to favor policies that are better for their sector, maybe even repeal some of the old administration's least favorable ones. I like United Healthcare, UNH, I like Boston Scientific, BSX, and I like Eli Lilly, LOI. I would also add the Russell 2000 small caps could potentially leg higher as there's a lot of domestic demand related plays in the index. They're also a beneficiary of interest rates coming off, considering lower rates improve borrowing options for smaller companies, enhancing growth and innovation. And they've been the laggards to large caps for a few years now. So there's a game of catch up left to play. If there is a mild recession that kicks off, however, there would be a flight to safety. So what we'd likely see is that move out of the Russell small caps into the safety of larger caps. Just always keep every option in mind and be ready to pivot when the data is going against your thesis, okay? So there you have it. That's my take on what 2025 might hold for markets and investments. Let me know in the comments below which trends you're most interested in and what you agree or disagree with. Now, I'm not one to ask for favors often, but if you found this video helpful, would you be so kind and give me a like and hit that subscribe button? I'm hyper-focused on building this channel into something fun, usable, and educational. Luckily, I'm enjoying the whole process because it's a shit ton of work. But anyway, also be on the lookout for my new Journey series that I'm dropping soon, where I take all the little confessional videos I made over the past year, documenting the challenges of leaving a great career to start this channel, many never meant to be shared, mind you, and upload them all on YouTube in chronological order. It should be somewhat embarrassing, relatable, and hopefully empowering. Enough so that I think they're worth sharing. Remember, kindness is the rent we pay on earth, so do something nice for someone. Happy holidays, and wishing you all the best in 2025.